Hi, this is Mike Ryan. I want to talk a little bit about funding and some of the changes that have happened in the past year or so, and it's 2012 right now. And really, it has had an impact, and interesting, we'll see what happens over the next few years and decade ahead as far as on the front end of funding, especially for entrepreneurs and founders that have developed a product to take to market and take it from that vision to a reality. Historically, and to this day, people who start companies will usually have an idea and for a product or a solution, and they will spend time developing that before they take it to market. And for products specifically, it may take time to develop, design, manufacture, and that takes capital. And that capital just simply means money. And that money usually comes from savings or things like 401k or savings in the bank that you've had over the years, that for that time as you take the product to market and you don't have revenue, you've got to be able to fund that. And most entrepreneurs and founders do that through having founding during the founding is through savings. The other area is what they call family and friends and people who are in your network that believe in you, believe that you have an idea and a concept that is worthwhile. But more importantly, they're investing in you and your team or your company, but really they're investing in people. And investors will tell you, from those that are in angel investing to venture capital to private equity, they will invest in not companies per se or products. They really invest in people. And are those people able to take a company to the next level that brings them a return on investment? So beginning at that friends and family, and sometimes people call fools, that invest in individuals at the startup mode, then it will come to usually what's called a seed round, where that ranges anywhere from someone who puts in, 50,000 or 250,000, or super angel, or a band of angels, which are a group of angels that come together, band together, look at investment, vet them out, and may, as a group or even individuals, invest in a company. And that's usually under $1 million. There's been others in more recent times, just because of the economics, that they will be in the over $1 million. But usually most seed investments under $1 million. Then is the venture capital that typically for technology companies is usually about $3 million to $5 million. And depending, there are exceptions to that. If you go into big data and it takes a lot of expertise to get that, you may have a larger round. And the other exception to that is biotech. That given that biotech is high risk, high reward, the need for capital is usually in the $30 to $40 million that is invested usually by venture capital, not necessarily seed. Going back to the so that's usually the stratosphere, not stratosphere, but the spectrum of investing. It begins with savings, then goes to friends and families, and friends and family within your network. The other would be a seed round with angel investors, and then venture capital that would go in what's called the Series A, which is usually $3 million for most technology companies or most product companies, or in biotech be more in the $40 million. And then you would have a Series B, C, D, and L until you get to the point where you have some type of either buyout or IPO or some other liquidating event. But an interesting phenomenon, I just had a conversation with a tech entrepreneur this morning, and they talked about a new platform that's out there, especially what's happened with the economy. And you have so many middle management and other people coming up through the ranks, may not be people who've been careers in corporations, that have an idea and want to take that idea and raise capital. And they may not have savings if they're, a teen entrepreneur, or there's someone in their 20s. They don't have 20 years of savings, and so they how do you do that? And they may not necessarily have friends that have capital or savings to help them in that friends and family. So the fourth and relatively new phenomena is using and leveraging the web to raise capital. And you've seen a number of these different types of platforms that are out there, online platforms. That the most notable, probably because the first mover to market, was KickerStarter. And there's some very interesting success stories that are there, but also there's others that are, you don't hear about, and you hear about the success story. And probably one of the most famous and infamous this year happened with Pebble. And I suggest you go and do some research on Pebble. But basically, Pebble, I think, went to market with a new watch. The founder actually went to a number of venture capitalists because they knew they would need quite a bit of money to take that product to market. There's a lot of watches in the marketplace, a lot of clutter and noise, and how do you come up with a new watch that competes with the high-end watches or the low-end sports watches or just other watches in the marketplace? And how do you, it's not necessarily new, but how do you promote that as your best thing? So Pebble founders took their concept to Kickstarter, and I believe they wanted to raise a few $100,000, at least initially, and let's say it was like $500,000 or so. To their surprise, they began that, I believe, in April 2012. Within a month, they had raised, I believe, it was roughly in the $3 to $5 million, which was really astounding. Ultimately, with over a 4-month period, I think they raised about $12 million. Now, that's an extraordinary case. The Kickstarter founders then were approached by venture capitalists and other money came in. But very interesting. The conversation with Entrepreneur today was that their story is that they were able actually to raise about $3 million, but it was a 24-hour-a-day operation. And the importance of tying in social media, tying in a viral market for their particular, usually these are products, which is kind of interesting. So you're not necessarily selling equity into these companies, you're selling your future products. And so in Pebble's case, it was a new watch that people were interested in getting. Others that I've personally been involved with is a production company that is developing a film, or they're developing some type of widget or product that is available to the public to buy. So they're not necessarily giving up equity, they're giving up future customers, and future products that customers will buy. One thing that I've said recently that I think is a great thing, the best source of capital, whether you're a product company or technology company, is the best source of capital is customers, paying customers, versus, I believe, other sources, because what that does is shows and validates the product in the marketplace, and you generate revenue. So I think something that is always been there in the fundraising has been the personal savings, seed and angel round, venture capital, and private equity. But the new one, which will be interesting to watch over the next decade, is the platform of crowdfunding. So keep your eye out on crowdfunding, and just know you still got to do a lot of work. It's just not about placing a video online and pushing send, and suddenly you may have built a better mousetrap, but they won't necessarily build it and they will come. So that's the latest that I've got on funding. We'll talk to you soon. Bye.